Hi there, I'm Mark Anderson. I'm a mortgage banker with Paramount Bank based in St. Louis, Missouri. But important to point out, I am licensed to lend in all 50 states. So no matter where you are in the country, if you're interested in getting a pre-approval for a new purchase mortgage and you've got questions that you can't find answers to online or from the guy that you talked to already, I am your guy. Give me a call, shoot me a text at the number below anytime, and we can kickstart that conversation. So what we're doing today is a mortgage rate update. And I got to tell you, I really wish the news was better than it is. But before I go into that bad news, I wanted to set some context in place. Last week, according to Freddie Mac, they perform a national rate survey once a week. Last week, they reported that the average 30-year fixed rate across the country was sitting at 2.96%. Based on what happened in the mortgage bond market today, I don't think that rate is going to stay that low. And I think that this change is going to be baked into pricing on every lender in the country on their rate sheets tomorrow morning. We've already seen some midday price changes for the worse today based on this information. But I think it's useful to keep in mind before I go into the nitty-gritty of this, that this is a market that really, truly defies prediction. The fundamentals, the things I learned in economics classes in college and from what I've read as an adult, the fundamentals are thoroughly out the window, and we're dealing with a market that is just fundamentally impossible to predict, certainly on a day-to-day basis. So there's a number of things that could happen tomorrow, next week, next month that could reverse this trend. In theory, we could see a reduction in rates after what is very likely going to be at least a small increase in rates. But what we have going on right now is not a good indication of that. It is an indication that rates may really be beginning to pivot toward moving higher overall, as I've predicted in some recent videos. So what happened today in the mortgage bond market? Let's switch over to the bond graph. So fundamentally what we're looking at here, if you have not seen my previous videos, I need to point out that there is a fundamental relationship between mortgage rates and mortgage bond prices. There is actually an inverse relationship between these two things. Basically, when mortgage bond prices go up, that causes rates to go down. When mortgage bond prices go down, that causes rates to go up. And what we see here, this is the 5-day view of the mortgage bond prices over the last 5 days. What we see here, last 5 days up to today, and you see what I'll describe as a cliff. This is a big reduction in the bond prices that happened pretty much as soon as the information from the Federal Reserve meeting came out today. So what did the Fed end up saying? The Federal Reserve has two main considerations at this point. Number one, the economy does appear to be improving overall. As the economy improves, the Fed is less likely to engage in stimulus of the bond market and many other of the stimulus programs that they have. So that's one thing. The other thing is they are finally recognizing that there is very clear observed inflation. That inflation rate is perhaps up to debate depending on the method that you're looking at, the people that you talk to, the economist whose opinion you're banking things on. But the inflation is very obvious to the point where the Federal Reserve called it out today. And really what the Federal Reserve can do, they're really the main weapon in their arsenal to fight inflation, interest rates. And when inflation is a concern, rates go up. And what the Federal Reserve basically came out and said today, although they didn't say it quite this simply, is that they are really going to need to take a serious look at tapering the Federal Reserve rates up. Now, this gets a little bit overly technical, and I'm going to really do my best here. It is not the case that the Federal Reserve controls mortgage interest rates. So when you see on the news that the Fed has raised rates, there's not a direct relationship there between the Federal Reserve raising their rates and what you see for mortgage rates. These things are related, but there's not a direct control knob that the Federal Reserve has over mortgage rates. The main influence that the Federal Reserve has over mortgage rates right now is the fact that they're buying a ton of the mortgage bonds. They're basically the single largest buyer of mortgage bonds right now with their bond buying stimulus program. So the Federal Reserve, to combat inflation, is taking a look at tapering up their Federal Reserve rates. but they have also at least implied, within the context of what they came out and said today, they've at least implied that they're also going to have to really look at tapering off the bond buying program at some point in time. Now, when that happens, that's really going to be the thing to look at that's going to cause an immediate increase in rates. So when the news comes out, the Federal Reserve has set a date for when they're going to stop purchasing these mortgage bonds. Expect not so pretty things as it relates to mortgage bond prices, and therefore you want to expect increases to interest rates at that time. So I think what we're seeing today, this drop-off in prices based on this Federal Reserve meeting, think of it as a sign of things to come. This isn't so dramatic that all of a sudden we're going to be looking at rates that are a percentage point higher or anything to that degree. I think as it relates to mortgage rates, what you might be looking at tomorrow is maybe 1/8% higher on the rate, maybe 1/4% higher on the rate than what we had earlier in this week. But I do think that it's one of the first signs of things that are certain to come. The Federal Reserve is not going to be in the bond market buying these huge amounts of mortgage bonds forever. They've never said they're going to do it forever. And today, if I'm reading the tea leaves correctly and understanding their messaging, they're certainly indicating to the people selling mortgage bonds that bond buying program is probably going to start tapering off sooner rather than later, as they're also going to look at increasing the Federal Reserve rates sooner than later. So that is the long and the short of what happened today. We'll look at the one-day view. I think this is a more dramatic view in some ways. This is status quo this morning, which rates really have been pretty stable over the last month or 2 months. Status quo, Fed meeting right there. Boom. Huge reduction in the bond prices based on what's going on at the Fed. Overall, this was expected. As I've stated in previous videos, the ultra low rate environment cannot last forever. It's very costly to keep this market in as favorable shape as it relates to mortgage rates for consumers. But this is not something that is going to last forever, and I think that today may be one of the first kind of pivot points toward higher rates in the future. So all that said, if you would like me to take a look at your mortgage scenario, or if you just have questions about some of the things I've said today, really anything at all, I'd love to hear from you. I don't need to, worry about taking an application from you. I'm not a high-pressure sales guy. I'm interested in talking to anybody that might work with me either soon or multiple years down the road. Happy to have that conversation. So again, call or text me at the number below anytime. Thank you so much for watching the video. Please do like the video, subscribe to my channel. I am desperate to get up to 1,000 subscribers so I can start doing some live streaming. So that's really my main goal right now, is to increase my subscribers so that I can start doing that. There's a lot of really cool stuff I can do once I have the ability to live stream. Please also share this content with anybody that may find it useful. Thanks so much.